Ever feel like the house always wins? Imagine walking into a casino, but this time you're holding all the cards. In this video, I'll reveal the secrets Forex brokers don't want you to know. Armed with this knowledge, you'll take back the power and trade with confidence. I've worked in the FX industry for 15 years, for some of the biggest and most well-known brands, through to smaller startups. I still do, and it's why I cannot show myself. Forex is big business. The guys who own the brokerages that you and I trade with make far more money than you can possibly imagine. These owners drive the best cars, have fancy houses, own mega yachts, private jets, and even private islands. The last thing they want to do is share their profits with some punk trader who got lucky. Running a successful Forex brokerage is a numbers game. Statistically, 70 to 85% of traders lose money, which directly profits the brokerage and the owner's pockets. Brokers prefer you to make the odd winning trade to keep you happy and coming back for more. But in reality, they prefer losers. Winners make profits at the broker's expense. Before jumping into the dirty tricks, credit where it's due, regulation of the Forex market has helped stop a lot of what was going on before. If you're trading with a Tier 1 licensed broker in the USA, Europe, or Australia, you're in a better, safer position than those who are not. This video is for those who want to understand and avoid the remaining pitfalls. Let's get into it then. The top 10 dirty broker tricks to avoid. Number 1. Rigged news. Fake news isn't just for politics, it happens in trading too. An analyst once asked me if we wanted truthful news and charts analysis or manipulated to cause traders to lose. He wasn't hired. The lesson here: always check more than one source for your market's news, analysis and signals, and value independent analysis higher than broker-provided information. Number 2. A. Book and B. Book. Trades are booked by brokers. If they think you're a loser, they'll take on your trade in-house on the B book. The vast majority of you will be B booked. Why? Because you're in that 70 to 85% I mentioned and will be paying off a loan on the owner's yacht. Winning traders, high depositors or large account traders may spook the dealing department and you'll get I booked, where trades are sent to a third party. In Europe, under MiFID II, you're entitled to see your trade execution report, detailing the execution venue. Number 3 is stop-loss hunting. Moving into the dark arts now. I know dealers who caused this to happen. Dealers push prices to trigger stop-loss orders, causing them to execute before quickly reverting. You'll never know what hit you. Number 4 is requotes. You attempt to execute a trade at a specific price, but the broker delays the order and offers a new, often worse price, forcing you to accept less favorable terms. Number 5. Slippage. Brokers deliberately delay order execution, causing you to enter or exit at a worse price than intended, especially during high volatility periods. This is sneaky and hard to prove. Number 6. Stop-loss feature. Did you know MetaTrader brokers can guarantee your stop-loss via a setting in their meta manager, but most don't? When disabled, your stop-loss might not work during market gaps. Some brokers do offer this guaranteed stop-loss order feature, which I'll list in the description. Number 7 is hedging. This is the big nightmare for all brokers. Hedging, especially with deposit bonuses, can be risk-free trading, which brokers dislike. Hedging may be prohibited in your agreement, and if suspected, you'll be kicked out. Avoid obvious patterns that brokers can spot. Number 8. Variable spreads. With razor-thin, ultra-low spreads starting from 0 pips, what could go wrong? Brokers may widen spreads during volatile markets, making trading more expensive and hitting your stop-loss orders. Trade on a fixed spread account to avoid this. Number 9. Negative balance protection abuse. Supposed to limit your loss to your account balance, some brokers manipulate conditions to create large negative balances, which they then pursue for payment. Number 10 is the classic trick: delaying withdrawals. Why? Because, if the money is stuck in the account, they hope you'll continue to trade with it. Remember the 70 to 85% rule? Worst case is that the owner is dipping his hand into the client fund's bank account and using it to cover the fuel costs for the yacht, and there actually isn't any money to repay you. I've seen this happen all too often. And one more, number 11, the big freeze effect. Brokers might fake technical issues to prevent you from closing a trade in profit, citing security alerts or DDoS attacks. Every second counts in such scenarios. So what's the solution? How do you combat these tactics? Pick regulated brokers. Choose brokers with solid reputations and read reviews and forum threads for red flags. Understand terms. Read the terms and conditions, especially about spreads, slippage, requotes, and withdrawals. Test brokers. Start with small deposits and withdrawals. Use small trades to check for slippage. Keep records. Record your trades and screen activity. Be prepared to confront the broker if necessary. Diversify. Have accounts with multiple brokers to reduce risk exposure. There you have it, the top 10 dirty tricks brokers use against you and how to mitigate them. Like, share, and subscribe for more insights. Leave a comment with your experiences or questions. Trade safe.